Hi, I'm Jessica Amir for the Finance News Network. Joining me from Real Estate Investment Trust Growthpoint Properties Australia is Chief Operating Officer Aaron Hockley. Hi Aaron, welcome.
Hi Jessica.
So first up, for those new to the company, can you give us a quick introduction?
Growthpoint Properties Australia is an ASX listed landlord. We have a portfolio of $3.2 billion of office and industrial property spread right around Australia. We have a market capitalisation of approximately $2.4 billion, making us one of Australia's largest listed landlords. We returned to investors 22.4% per annum over the last 5 years, which is about 4% above the property sector average.
And just tell us how you differentiate from your competitors.
Firstly, we focus solely on income. So we're trying to return an income stream to our investors growing at approximately 3 to 4% per annum. Secondly, we invest solely in the office and industrial sectors in established properties. We have a high security of income as a result. And finally, our major investor, Growthpoint Properties Limited, is South Africa's largest listed property group with assets of Australian $12 billion. And that access to capital enables us to pursue transactions that many of our peers can't.
Now to your FY17 results. Aaron, what were some of the highlights?
We had an excellent year in FY17. We acquired over $470 million of assets at an average yield of over 7%, and we divested around $260 million of assets, well above book value, to enable us to de-risk future cash flows. We also leased over 100,000 square metres of office and industrial space, allowing us to retain occupancy at 99%. We also have had a focus on sustainability over the last few years, and two key measures on that front. We increased our average neighbours rating across our office portfolio from 4.2 stars to 4.5 stars, and we increased female participation or female workforce participation from 34% to 45%. Most importantly, we increased our earnings by 12% per security and our distributions by 4.9% per security.
And Aaron, can you give us a little bit more detail about your property portfolio?
Our office portfolio, which makes up about 2/3 of the total, is worth around $2.1 billion and is primarily A-grade office properties in core CBD and inner city locations. Our industrial portfolio primarily comprises logistics, so large warehouses leased to the likes of Linfox. Over 81% of our portfolio is located across Australia's eastern seaboard, and 90% of our income comes from government or listed tenants. And
Aaron, this financial year, how are we shaping up?
We've acquired an industrial property for $46 million, and we've acquired an 18.2% stake in the ASX listed industrial REIT, both of which were accretive to earnings. We've also divested a $90 million industrial property, 40% above its previous book value, and that's enabled us to de-risk future cash flows and to reduce balance sheet gearing. We've undertaken around 21,000 square metres of new leasing, and we're now looking to commence building a new 20,000 square metre office property in Richmond, Victoria.
And Aaron, with the arrival of Amazon in Australia, is that affecting the business?
As the owner of a large logistics portfolio and not having any retail properties in the portfolio, we actually think Amazon will be good for our business. More tenant demand for space and more purchaser demand for properties will increase both our rental and also increase our underlying property values.
And just wrapping up, Aaron, what's your guidance for FY18?
Our FFO guidance or earnings guidance is 24.3 cents per security, and our distribution guidance is 22.2 cents per security, and that's an at least number. Those figures provide an EPS yield of about 6.8% and a distribution yield of 6.2%, so well above the sector. An investment in Growthpoint Properties Australia is an investment in a stable, growing income stream, quality properties spread right throughout Australia.
Aaron Hockley, thank you so much for the introduction and good luck with the rest of the financial year.
Thanks, Jessica.